Radio show to join us, which we appreciate. Thank you, Peter. And the next guest was actually the lone Fed dissenter at the last Fed meeting, saying no more stimulus from the Federal Reserve. Talking about the Richmond Fed President Jeffrey Lacker. He's with Peter Barnes now in Washington. This is an exclusive interview. Take it away, Peter.
Yeah, that's right, Connell. Let's just continue that conversation with Jeffrey Lacker, who is a voting member of the FOMC. He has been the dissenter all year long at the Fed. And let's start off with the announcement last Wednesday, President Lacker. The announcement included a downgrade of the economic outlook, and a lot of analysts that I get research notes from said, well, this means that another round of quantitative easing is coming. Is it?
Nothing's ever a foregone conclusion. We take everything a meeting at a time, and it's going to depend on how the data comes out. Growth has clearly weakened in the last couple of months, but if you look back over the last couple of years, it looks like this recovery is one that's going to be characterized by swings between stronger growth and much more disappointing levels of growth.
But we saw in the statement, it sounded just very kind of dovish. The committee anticipates that the unemployment rate will decline only slowly towards levels that it judges to be consistent with its dual mandate. That sounds like they're setting the table for another round of QE3, maybe not with your vote, but...
Well, we'll take it as it comes. I think monetary policy doesn't have a lot of capability right now for really enhancing the growth we're seeing out in the economy. I think the impediments of growth are things that monetary policy is really not that capable of offsetting. I think we're going through we have a major fiscal adjustment ahead of us in the United States, and I think the size of that, the dimensions of it, where it's going to land, who it's going to affect is very uncertain, and I think that uncertainty is having a detectable effect in inhibiting growth right now.
So you don't think that additional stimulus QE3 could be effective? The Fed chairman, Ben Bernanke, said in his press conference, hey, we're not out of ammunition, we're not out of bullets. I think it can be effective, for example, in helping to bring down mortgage rates even further, which might help the housing market.
I think the stimulus can be effective in raising inflation, and that's what we know from centuries of economics to be true. Whether it affects growth or not depends on the circumstances, depends on the situation. I don't think we're in a situation where it would have a meaningful effect on stimulating growth for beyond a transitory period, and I think that further stimulus at this point would most likely just raise inflation. Inflation's running around 2%. That's our stated objective. I don't think we want to increase it from here.
But where do you see inflation perhaps lurking in the economy?
Well, you don't want to see it lurk. You want it to average around 2%. We had it below 2% for a while. It's come up to 2%. We've got a little bit of softness on the inflation front now with oil and energy prices coming down, but our history with that is that they tend to be transitory. I think inflation's headed back to 2%.
Well, what should the Fed be doing right now as far as policy goes? Should it be raising interest rates right now, or what?
No, I'm comfortable with a broad amount of monetary stimulus out there in terms of our stance. I think we're okay now. I don't think we have to withdraw monetary stimulus right now. I don't think we have to begin exiting right now. But I think we're going to have to try and do it in a way. We're going to have to choose the right time so that we do it to prevent inflation from rising. We don't want to wait until inflation goes up. At that point, it'll be too late.
So raise rates sooner rather than later?
Well, my sense has been over the course of this year that we were likely to need to raise rates sometime in the 2013 time horizon. Maybe late 2013 is a little more appropriate now with the growth outlook weakening, but I think we're probably going to have to raise rates next year but it's going to depend on the data. That's not a promise.
And finally, you haven't closed the door entirely to an additional round of quantitative easing if you see prices starting to fall.
If inflation fell in a sustained way and we needed to boost inflation to get it back to close to our target, I would favor monetary stimulus. No question about it.
All right. Jeffrey Lacker, the Richmond Federal Reserve, thanks for joining us live on Fox Business. And Connell, we're going to continue this discussion with more questions about the economy, headwinds, housing, Europe. And we're going to post that exclusively to our website later this afternoon.
Okay, Connell? Sounds good. FoxBusiness.com. Peter, good interview. Thank you very much. And also today.